You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
So if you're going to take a risk, you might as well bet on an opportunity that if it pays out and works, you're going to be well rewarded for it.
Thank you for tuning in again to Mining Stock Education. I'm your host, Bill Powers. Today's show is brought to you by Luminex Resources. Ticker symbol is LR in Toronto and LUMIF in New York. Luminex is part of the Lumina Group, which has an excellent track record of value creation, having raised US $290 million, which it turned into $1.6 billion returned to investors through the sale of its companies. To learn more about Luminex, please go to LuminexResources.com. Well, my guest today is Matt Geiger, Natural Resource Fund Manager of MJG Capital. Matt recently put out a letter to investors, which I'm going to put a link to in the show notes below. So Matt, thanks for joining me to give us your take on what's going on as gold hits all-time highs. As this market is so hot right now, has this at all changed your approach to how you invest in these resource companies?
Firstly, thanks for having me back on, Bill. And I must say it's been an exciting few days. Got the investor letter out on Friday. It's posted at the fund's website at mjgcapital.com. So got that monkey off my back for the time being. And then today we wake up to all-time high gold prices in US dollar terms. So very exciting times. To your question, no, the market environment really doesn't change the way that we invest in the MJG partnership. I have my investment style. I'm sticking to it. I guess the key differentiator would be just the people first focus. We're always going to invest in management teams where I have confidence that they're going to conduct themselves ethically, that they're committed to the story and to create true value versus just making quick paper profits themselves. And that they also have the skill set and the expertise to actually accomplish the goal that they're setting out to do. I'll also say from a project perspective or an asset perspective, our style has always been to invest in projects that they definitely have to have the right scale. So, I think Ross Beatty has it absolutely right where he says a small mine has just as many risks as a big mine. So if you're going to take a risk, you might as well bet on an opportunity that if it pays out and works, you're going to be well rewarded for it. But the second point is we've always invested in projects that are economic at the current metal prices or at even less. So I don't like to bet directionally on metal prices. I like projects that work. And if gold sits at 1900 or if copper sits at 290 for the next 3 or 4 years, we want the vast majority of our portfolio to be exposed to assets that can still be advanced and potentially even taken into production in that environment. We're not optionality investors. I have nothing against that style of investing. An optionality investment is where you bet on a low-grade bulk tonnage project that really needs metal prices to increase substantially to even make sense on paper. If you're right on your macro call and you do get those higher metal prices, then the leverage for these companies are extreme. But I'm just, as an investor, not a phenomenal market timer by any stretch of the imagination. And so I like to invest in those projects that make sense now. And if the metal prices work in our favor, then great. That's gravy on top.
Where do you see the market rewarding companies the most in the resource sector right now? Sometimes they reward high grade discoveries more than producers. Where are you seeing the market rewarding?
Well, I think you nailed it with the post discovery plays, which I'm quite encouraged to see. I mean, I would argue that we haven't had a proper discovery driven bull market in over 2 decades at this point. Probably the last was in the 90s, which was before my days as a junior resource investor. Even the 2002 to 2007 commodity bull cycle, the projects and the companies that were primarily rewarded were these large, high tonnage projects with lots of pounds or ounces in the ground that became immensely valuable as Chinese driven demand drove up commodity prices really across the board. For investors that made money in that cycle with that strategy, I think they may be somewhat dismayed with what these upcoming few years have to come. I think the miners and the larger producers that will be acquiring some of the better junior projects, especially in the gold producers, have learned some very painful lessons about buying high grade projects high tonnage, low grade projects with the assumption that metal prices are going to continue to rise infinitely. And so I think they're going to be much more selective with the types of projects that they're willing to acquire and to bring into production in the coming few years. At least I hope that's the case. And I think if they can stay disciplined, that's going to result in a longer and more drawn out bull market, which I think is in all of our best interests as investors.
There's been a slew of private placements and financings that have been offered. I'm sure that you're reviewing numerous per week, at least, especially in the last month. I mean, what would a private placement have to offer to you at this point for you to pull the trigger on it?
I mean, it's been crazy, Bill, and I know you're well aware of that. Just the amount of deal flow that we've seen. Just even the past 4 to 6 weeks has been a little bit overwhelming. I will say that I really do try as an investor to keep a portfolio that is concentrated at most 20 publicly traded names at any given time. Obviously, sometimes I'll go a little bit above that, but I think as an investor, that's important for a few reasons. The first is that it's much easier to keep track of each of your companies and have a pulse on their news flow, how the company's doing, and you make better decisions on when to potentially add more or when to exit and liquidate. Secondly, if you keep a concentrated portfolio, when one of the stories pays off, you have enough exposure as is within the portfolio where it actually moves the needle for your overall portfolio. So with that said, I'm trying to be very, very selective, as we always are. And of course, with this deal flow, that can be difficult, but I would just encourage all investors to be as disciplined as they can. If you're speaking specifically to gold and silver focused stories or gold and silver focused placements, I mentioned in the letter that the bar is really that much higher, even higher than it normally would be. And that's just given our current portfolio construction. We're basically 2/3 weighted to gold or silver equities right now, which I'm quite comfortable with that weighting. It's higher than we've ever been since the partnership's inception. But where we are in the market cycle, I'm all right with that. This is not going to ever be an all full precious metal focused fund though. And so with that in mind, we will consider gold and silver new positions, but with a very high bar. If it's a company that we already own and they're doing a placement, if I like the progress the company's made, if I think the valuation's not too far out of whack, then we'll happily participate. And I'll be a little bit less stringent on deal terms. And that's true for all of our companies, whether precious metal focused or not. But in this environment, specifically for precious metal investments, I'm really not even going to look closely at the deal. Unless I have a strong relationship with management already, know the asset very, very well, and or know and trust and respect investors that are coming into this financing and can vouch strongly for the team in charge. If 2 out of those 3 boxes or all 3 of those boxes aren't checked, then I'm not even going to dig all too deeply into the deal. And additionally, if I'm going to add a new gold and silver focused name to the portfolio right now, I'll also want to see a full warrant most likely attached, which is again a very high bar for this environment because companies are able to raise with half warrants or even in some cases without warrants at all. But just for the sake of being selective, I want all those boxes to be checked before we write a check.
Yeah, last week I was presented with a private placement, and it was a half 2-year warrant, which just at this point in the bull market, that wasn't even attractive to me. Kind of what you're saying here.
Exactly. Yeah, and again, if it's a position that we already own, and I like the management team, I like what they're doing, the company's on the right track, then I want to be supportive, and we're going to be less selective. But if it's considering adding a new deal to the portfolio, like you really want that full warrant, at least for the precious metal focused names right now.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Matt, I remember listening to an interview you did a few years ago, and you were talking about your planned exit strategy for this gold bull market. And I thought to myself at the time, I couldn't find exactly what you said, but I thought, I wonder if he's selling too soon. Can you kind of give an updated view on your exit strategy for your precious metal stocks?
Absolutely. I'm not quite sure what previous interview you're referring to, but I'll just answer your question straight here. As a value investor, like I feel that investors really would be behooved to firmly look at their individual investments on a case-by-case basis. And it's important to me to have a share price number in mind for where the company should be valued. If it's more of a value investment, that would be considered either the fair value or intrinsic value. What is this company worth per share today? And if it's more speculative, then I would consider that to be the speculative value per share. If things go right, risk adjusted, what is a reasonable share price for where the company's at? And then you just compare that to the current share price, look at the delta, and go from there. So I don't want to have any overarching extreme rule for selling here. I just think you need to look at each of your holdings individually and take profits and potentially take your entire investment off the table when you see the share price approach and surpass what you deem to be that fair value or speculative value per share. I will just say generally, I think we run a risk, especially if this is a very powerful and sustained precious metal bull market, that we get too greedy as investors as well. So I agree. You don't want to pull out too early. You also don't want to ride it over the top and leave substantial amounts of money on the table. So one way to address that could just be to have kind of a portfolio weighting limit within your portfolio. For individual positions, we have this. We limit the maximum position that we'll initiate at cost is 10%, and then at market is 20%. So if we put our maximum amount into a placement and the company doubles, no matter how well the company does from there on out, no matter how much more value I think there's to be had, we'll be selling on the way up. You can do something similar with your overall portfolio. I wouldn't recommend investors do this quite yet, but if we're in 2021 and things are going really well and you're seeing generalists continue to just pour into the space, rather than trying to call the top, you can just say as an investor, look, I'm not going to allow gold and silver related equities to be weighted at more than 15% of my overall portfolio, or 20% of my overall portfolio, 10%, whatever is appropriate for that individual investor. And that's just kind of a little bit of some handcuffs on you to be smart. And any time that you have a really good week with your gold and silver equities, you look at the overall weighting of your portfolio. Oh, we're at 17%. I want to be down to 15%. Okay, I'm going to take profits from a few of my names to get that. You just keep doing that, as things go up, and you reposition your profits either in other natural resources, not precious metal related, or in other investments entirely. So I think that's a decent way that you can stay disciplined without jumping out too early and also not riding over the top. Neither of those are good.
These pre-revenue companies have to issue shares in order to get cash to move forward with their programs. Some of them can get in really bloated share structures and still be far away from cash flow. For you, when you're looking at a company where you like a lot of the aspects of it, but it has a bloated share structure, can you talk about what you would need to see positively going on in that company for you to invest in it?
Certainly. I really like this question, Bill, because I will say I think investors in general are too concerned with bloated share structures, or at least they're worried about it for the wrong reasons. So I will say, as an investor, that's not a massive red flag for me. In fact, I would argue that there's nothing inherently wrong with a bloated share structure. At the end of the day, if you are a value investor, all that should matter to you is the company's valuation. And that's the company's share price times the shares outstanding. And that gives you a number of where the company's currently valued. Then you look at their assets, you determine how much those are worth. And if there's a substantial delta between them, it's a good investment, whether the share structure is bloated or not. That said, I think in practice, there's a reason that people over time have come to try to avoid or be concerned with bloated share structures. And that's because it's often associated with certain things that really do matter. I would argue that the bloated share structure can sometimes be a symptom of an overall illness within the company. And that illness could be low insider ownership. Oftentimes, but not always, if you see a bloated share structure, that's associated with management and board owning less than 5% of the company per se. Oftentimes, if you see a bloated share structure, that's associated with a company that's been serial diluters. And if you're a serial diluter, that generally means that you're spending a lot of money for either promotion and or company overhead or paying management salaries, all that good stuff, which is good for management teams, but not good for investors. Another thing that you'll see associated with bloated share structures are projects that have just been reflogged cycle after cycle after cycle without being built, without being advanced, without being bought by a major company and tried to be taken into production. So those are the kind of the sicknesses that cause a bloated share structure. But I would just argue that on its own, there's nothing inherently wrong with that bloated share structure, and investors should really focus more on the company's valuation. The share structure alone, without looking at the share price, doesn't mean a whole lot.
Matt, when you're talking to CEOs of companies you're invested in or potential investments recently, what type of advice have you been giving some of these CEOs as we've been seeing the precious metals prices go up?
Well, I think a couple points. It's easy to get greedy, especially in this market environment and what we've seen over the past 8 weeks, at least in the junior space and a little bit longer for the bigger miners and the GDX and the GDXJ. I would just remind CEOs and investors where we were in March, which seems like an entire world away, but was really only 4 months ago. Speaking for myself, investors were curled up in the fetal position, wishing that they were entirely in cash and really suffering with the market sell-off. And now, just a few months removed, kind of the greed and euphoria that we're seeing in the market, to me at least, is pretty jarring. So we need to keep in mind that this is a cyclical industry, this is a volatile industry, and times will get bad again. I'm not quite sure when, but they will. So with that in mind, what do? I think as a company, you should take capital right now. Dilution hurts, but money is available for companies with theses to prove, with catalysts that they're trying to fund. Take the money if you can, would be kind of my main point to drive home. And then the second point would be, and this only is relevant to a company of a certain stage, you don't want to rush into drill programs just for the sake of promotion. So if you're out there working, ground truthing, doing geophysical surveys, doing sampling, grab sample, channel samples, there's no reason to rush that work or cut it short to drill. But if you have a project where you're comfortable with certain targets, I see there's really no reason not to be drilling right now. As a company, if you're at the right stage, because the market is richly rewarding these post-discovery plays. I mean, I would argue that's probably the segment of the market that's just seeing the most love right now. Whether it's the Vislas of the world or these names that have seen really rich hits and their share prices triple, quadruple, quintuple on the aftermath of that. So as a company, get out there and get the drills going if you can. And if you get a positive hit, that you'll be richly rewarded in this environment.
You're also bullish on copper. Copper closed in on $3 a pound. Recently, there's been a little pullback down to about $2.90 or so, but that's still up significantly since mid-March, where it was down, I believe, around $2.10. What do you think's been the primary driver behind copper's rise in price?
Well, it's a good question. I mean, in the investor letter that I just sent out, I had a nice little piece on the copper gold relationship between those two metals, and noted that in the past 30 years, gold has only been more valuable relative to copper twice in that 30-year period, and that was in the early 80s. So I think just from a reversion to the mean perspective, copper had some catching up to do. I think also just the gross amount of economic stimulus that's been pumped into economic systems globally has kind of driven this hope that there's going to be increased industrial demand. I don't want to be too cautious or too pessimistic, but still at this point, I'm not yet convinced that we're in a broad commodities bull market at the moment. I think it's possible that what we're seeing is a precious metals bull market with the backdrop of broader deflation or disinflation. I'm willing to change my mind. There's a few key levels that I'm looking at for different commodities. One of which is copper. I think if we see copper break substantially over this $3 US per pound level, that's going to give me more confidence that, hey, maybe this is a broader commodity based bull market driven by inflation and not just precious metals specific for the moment. Other levels of note, and these are some interesting technical levels given by Michael Oliver, would be $45 oil, $9.30 soybean price for those following kind of the ag complex. And then just the Bloomberg Commodity Index generally. If we see a monthly close above $73, then from a technical perspective, that's looking like a breakout from a long-term bearish trend. So those are a few different metrics that I'm looking at, and if we see 3 or 4 of those break above those key levels in the coming months, I'll be more comfortable saying, hey, we're here for commodities generally. But until then, I want to be a bit more cautious on the base and energy metals, as much as I love their future medium and long term.
Matt, when you're looking at gold projects and you're looking at the byproduct credits that go along with that gold project, do you prefer a copper byproduct credit over all other potential mineral credits you could get?
Not really, Bill. I mean, yeah, I guess all things equal. I do like polymetallic projects, and if you can get a copper kicker in there, then that's great. But in practice, as an investor, I'm really just looking at the economics at spot metal prices or even at below spot metal prices, and whether this project makes sense. Whether the initial capex is going to be well below the after-tax NPV using reasonable assumptions. Whether you can have an IRR of 25%, 30% or higher. Whether you're going to get a quick payback of 3-4 years, preferably sooner than that. And so to me, I just look at the gross metal value, and I'd much rather invest in a high quality, project that's 100% gold with no byproducts or no kickers whatsoever, than a mediocre copper gold porphyry with a 50-50 value split. So yeah, in practice, it's not something I look at. I guess to your question, though, all things equal, yes, I do like polymetallics, but it really does not drive our investment decisions in any respect.
What's your thoughts on the nickel market and potential nickel investing opportunities?
I mean, I like nickel. As I mentioned earlier in this call, I try not to take aggressive views on specific commodity prices, and instead bet on management teams and projects that make sense at current prices. But there are a few metals out there that I'm very enthusiastic about over the medium and term for sure, and nickels would be on that list, probably alongside uranium, and we can loop copper in there as well. I'm sure a lot of your listeners are aware of Elon Musk's comments just last week on Tesla's quarterly conference call, pounding the table for nickel producer or nickel development projects to get out there, raise construction financing, and he says Tesla will be there for long-term contracts. That remains to be seen. It's going to take more than Mr. Musk to just say he wants something to be the case. Tesla's going to actually have to come up and offer attractive prepaid offtake agreements for these deposits to get them up and running. But I think that definitely caught the attention of generalists and people that haven't been following the nickel market as closely as some of us. I would say, given where we are at this point in the cycle, nickel definitely hasn't bounced as sharply as copper, and has been ignored after getting a lot of attention last year, in particular, with the shutdowns in Indonesia. I think at the moment there's no reason to get too fancy with these nickel stories. If everything's on sale, go for the best, and those are usually the nickel sulfide projects that are big enough and hopefully in the lowest quartile or lowest half of the cost curve. And so for me, whether it's if it's a sulfide asset, whether it's a producing sulfide asset, one in development, a post-discovery play, or even an exploration play where they're looking on some highly prospective ground for the potential of a Voisey's Bay or a Norilsk-like discovery, I think that's the place to be right now. The other option really is to bet on the laterite plays, which again, that's more of an optionality strategy. If nickel goes to $15 or $20 per pound, you'll probably end up actually making more with the laterite plays that make no sense at current spot prices, but on paper will be worth a ton at those nickel prices. But I think that the more conservative and better way to go about it is to focus on the higher quality sulfide assets for now. And we can adjust if need be as the cycle continues.
As we bring this conversation to a conclusion, what type of feedback have you been getting from your investors? I'd like to hear, to get kind of the pulse that people are sensing right now in this bull market.
Yeah, I mean, my investors have been very supportive, and they've seen a lot, especially some of the original partners. So I appreciate them sticking with me through times both thick and thin. So yeah, in terms of feedback, I guess I've been a little bit more preemptive. To be honest, I'm a little bit sensitive to having underperformed the GDX and GDXJ over the past 6 months. I think there's a reason for that. I'm not concerned, but I'm letting people know part of the reasons for this. And there are a few of them. The first is that we are 20% of our overall portfolio is in private names at the moment. And so those are naturally going to lag and not re-rate in lifetimes, like our publicly traded equities. The second is that we really are focused on the junior spectrum of the market, the exploration and development stage names. And crazy enough, we only have one currently producing miner in the portfolio right now. So when the cycle turns and you start seeing those inflows, naturally they're going to go to the big boys first, the big multi-asset producers, and whether that's the precious metal names or base metal names, it's going to be the same. But I feel firmly that if this cycle continues in this vein, we'll see the trickle down effect that we always have, and that's to our advantage. We are on the smaller side of the spectrum, and I would argue that just over the past 4 to 6 weeks, that's when we finally started to see interest come into the game. And then I would just say that as a third point, we aren't a precious metal focused fund, and we never will be. It's risky enough to invest as a with a natural resource mandate. This is insanely cyclical and volatile market, and I think while it admittedly would maybe be easier to market to new prospective investors in this exact environment, to me it's just too crazy to refine or to define your investment mandate to only 2 or 4 metals if you want to include the PGM. So I'm pretty happy with our 66% weighted exposure to gold and silver, but we do have some other names, whether it's copper, ag, or nickel, or 1 or 2 zinc names that have lagged the precious metal names. I think their time has come, and I'm willing to be patient with them, even if it makes our portfolio lag in the immediate term.
Matt's website again is mjgcapital.com, and I will put a link in the show notes to his July 2020 investor letter that we referenced in this discussion. And if you'd like to get Matt's insights, I believe on a biannual basis, go to his website, mjgcapital.com and sign up for his email list. Matt, as always, appreciate your insight and thanks for coming on today's show.
Always a pleasure to join you, Bill. Thanks for having me. We'll talk soon.